Well, welcome everybody to our next installment in the workshop on entrepreneurial finance and innovation seminar series. We're really excited to have Jay Ritter from the University of Florida here presenting some work on SPACs, which is a timely and I think important topic going forward for the public and private markets. Before I hand it over, let me provide some logistics. So Jay's got 40 minutes, followed by a 15-minute discussion. And in turn, we'll have a 10, 15, depending how excited you all are after that for deeper questions. The logistics will specifically be, if you have any questions for Jay and co-authors, just use the chat. Song and the other organizers will be here to occasionally use the pause in the presentation to ask Jay some questions. So if you have a clarifying one or a deep one, use the chat for that purpose. And if you have a bigger question later, we'll unmute you in the Q&A. So I think with that, I'll put the paper in the chat so everybody can see it and download it from SSRN. Otherwise, Jay, the floor is yours.
Okay, thank you. This paper is co-authored with Minmo Gahng, who's a doctoral student at the University of Florida, and Donghang Zhang of the University of South Carolina, who is a graduate of Florida. And this paper is about special purpose acquisition companies, SPACs, something that, as we all know, has gotten a lot of attention in the last 12 months, even though 12 months ago, a lot of us had probably barely heard of them.
Jay, you got your slides. 1 second. I think you may have been the wrong screen. I think we.
Oh, okay.
We had your slide a few minutes ago. But...
Oh, okay, so it has not moved to slide 2?
No, I see your browser. I don't see your slides.
Okay, let me... let's see.
You have multiple monitors. You may want to drag that one to where the browser is at this. Yes.
Ah, there we go.
There we go.
Hey, Jay. Perfect. Thanks, Jay.
And let me just test. Was that going back to the
No, it's perfect.
Okay, good. Okay, we see the booming market here. From 2010 to 2016, there were 10 or maybe at most 20 SPAC IPOs each year. Then it increased a bit. In 2019, there were 59. Last year, there were 248. In the first 3 months of this year, 298 SPACs had already gone public. Now, it's recently slowed down. Last week, no new SPAC IPOs occurred. The way SPACs work is, and there, as we just mentioned, there's been a lot of press attention on this, but the way SPACs work is a company goes public, a sponsor creates a SPAC, takes it public, and typically sells 80% of the stock to the public, raising cash, and the sponsor gives itself the other 20%. And most SPAC IPOs involve a unit that is typically composed of a share plus a warrant to buy a fraction of a share. And the public units then typically after about 2 months start trading separately as the shares and a warrant. And the shares have a feature where they're redeemable. The unit almost always sells for $10, and the sponsor takes the money, pays investment banking fees out of its own pocket, and puts the $10 into a trust account where the shareholders have a money-back guarantee on it after a merger has been announced, a merger proposal, or liquidation. and we'll get into those details in a moment. The warrants become effective after a merger occurs. If no merger occurs, the warrants expire worthless. But a typical warrant structure has 5 years maturity after the merger. Almost always, it's got an exercise price of $11.50. So the right to buy a fraction of a share at $11.50 per share. And they're almost always capped as well, typically at $18, where if the stock price goes above $18 for a period of time, the sponsor has the right to, or the merge company has the right to force early redemption on those warrants, or early conversion on the warrants. So they're valuable warrants, but the upside is generally capped. But these warrants are definitely worth something. As a rule of thumb, the warrant to buy a full share might be worth $1 or $2. So at the time of the IPO, this unit is selling for $10 what essentially is a default-free convertible bond, in that if the holder likes the merger, they get to keep the share, and so they've got that upside potential. If they don't like the merger, they can redeem for $10 in interest. And so it's like a convertible bond, but it's better than a convertible bond because the money is put in an escrow account, so there's not default risk on the bond. Potentially there might be fraud or something, but to date there haven't been any instances, and every single SPAC IPO since 2010, when this practice of putting $10 into the trust account started to occur, every investor has gotten at least $10 back at the time of the merger. But it's even better than a default-free convertible bond because you've got this warrant as well. So SPACs for years have essentially, the IPO has essentially been an underpriced convertible bond. And it's not too surprising that it hasn't been difficult to find buyers at the IPO. Indeed, until recently, most of the buyers were hedge funds that also frequently levered up, but they figured out what a great deal this was. The sponsor then has typically up to 2 years to propose a merger and get shareholder approval. And it's only the public shareholders that have the right to vote on the merger. The sponsor shares don't have voting rights for the merger. So in that regard, it's dual class stock. There's the sponsor shares and there's the public shares. But unlike typical dual class stock, the insiders actually have less voting power than the outside investors do. So for the typical SPAC, we've got this life cycle where there's the IPO. The sponsor then searches for a target. They then, once they find some private operating company, or it might be a division of another company that's being spun off, they negotiate deal terms. And then they might look for a PIPE investor, private investment in public equity. And then at some point announce the proposed merger with the deal terms, where one of the things they're negotiating is how much cash minimum is the SPAC going to deliver. And that partly depends upon how many shares get redeemed. You might have an IPO that raises $200 million. And if nobody redeems, they've got $200 million in cash to deliver, minus some expenses. If the stock price is at $10 or below, however, all of the shareholders might decide to redeem their shares and get $10 in interest. And then there's a problem because the SPAC doesn't have cash to deliver. So this is where there might be some renegotiation, including PIPE investment, might provide another $150 million. And the merger agreement might be structured that the SPAC has to deliver at least $150 million. Or the sponsor might agree to take a haircut. The sponsor has gotten 20% of the shares. So if they sold $200 million worth of shares to investors at $10 each, that means public investors have 20 million shares. The sponsor would have 5 million shares. And typically at the time of the IPO, the sponsor also buys warrants, typically paying $1 or $1.50, basically a fair market price for warrants, and might invest $7 million, $9 million. And that cash goes to pay operating expenses while they search for a merger partner, and also for underwriting fees. Almost all the SPAC IPOs involve 5.5% underwriting fees, of which 2% gets paid upfront, and the other 3.5% only gets paid to the underwriter if a merger occurs. So, 2% of $200 million is $4 million. So the sponsor is putting in $4 million to top up the trust account for the public market investors, and putting in a couple million more to cover operating expenses. Before 2010, the deal terms weren't as attractive to public market investors. Instead of the sponsor putting up $7 million or more upfront of their own money, typically the $10 offer price would be partly used to pay investment banking fees and expenses. And so less than $10 was put into the trust account. But in the last decade plus, those IPO terms have become more investor friendly. Let me pause at this point for a moment if there are any questions that have come in.
Hey, Jay, there's kind of one question, I guess, is so basically has the SPAC structure been the same since its beginning, let's say early 2000s, or it has structural breaks in the middle?
Yeah, in the 1990s, the SPAC structure was less attractive. If we go back to the 70s and 80s, there were blind pool offerings, typically a couple $1 million with a sleazy underwriter, and the money was not put into an escrow account. A lot of the times they would buy a company owned by the promoter's brother-in-law, and the money would get paid out in salaries to the promoters, and it got a pretty bad image. But starting in the 1990s, the modern structure of SPACs occurred where there was this trust account, a third party, like a big commercial bank holds the cash, and the money has to be returned to investors if a merger doesn't occur within a certain period of time. But in the 90s and early in this century, typically the sponsors didn't put as much money up front of their own money, and like only 85% of the cash raised was put into the escrow account. And then most of them were traded OTC, whereas in the last 9 years, all of them have been traded on NASDAQ or the New York Stock Exchange. deal sizes have gotten bigger. There was a drop off around the internet bubble in terms of new SPACs. And then in the 2008 financial crisis, SPAC IPOs completely dried up for 2 years. But then when they started again in 2010, they became more deal friendly, investor friendly. We'll see in a moment. The last couple of years, deal structure has also been changing and continues to evolve.
Was that the main reason that you chose to start the sample starting from 2010?
Yeah, and practitioners refer to the last decade as SPAC 3.0 as kind of a structural break where the deal terms are more investor friendly.
Cool. And then the last clarifying question is, do shareholders need to approve the deal or only if more stock will be issued?
No, shareholders need to approve the deal. And this is a structural difference in the 2000 to 2007 period. And during that period, the number of SPAC IPOs was increasing. It kind of peaked in 2007, around the same time that the buyout boom peaked before the financial crisis. For those deals, some of the deal terms were different, then they were typically smaller, as I say, they were usually traded OTC.
Perfect. Thank you. Please go ahead. I see a lot of other questions, but I feel like those questions are not really clarifying.
Yeah, these SPACs are pretty complicated, and there's a lot of institutional detail.
Right.
To be honest, a year ago, I knew very little about SPACs. But kind of the origin of this paper is last summer, 2 practitioners reached out to me and said, we've got all this data on SPACs. Would you like to look at it? And we realized that there had, the market was booming, and Donghang Zhang had started on a paper about 10 years ago dealing with the previous SPAC bubble. But I shouldn't call it a bubble, the previous SPAC period, but had never published it, but was very knowledgeable about structure of things. One big difference between the 2007 period and now is it used to be that for the SPAC IPO investors, those units, the shareholders voted on redemption and approving the merger, but those votes were linked. If you voted to get your money back, you voted against the merger. And this gave some hold-up power to hedge funds. If the structure required 60% shareholder approval, and a hedge fund held 5% of the shares, and it looked like 58% of the other shares were going to vote in favor of the merger, that hedge fund could go to the sponsor and say, look, I'm going to vote against this merger and make your shares and warrants worthless unless you give me some side payments to approve the merger and not redeem. That happened. And these hedge funds became known as the SPAC mafia. And what would happen frequently is, say, on a $200 million deal where the sponsor had 5 million shares, they might say, okay, in order to get this deal approved, we will give you, hedge fund, 1 million of our shares, and we'll keep the other 4 million, but this will lower your average cost, and it'll allow the deal to get approved, and there'll be enough cash there to complete the merger. What happened starting in 2010 is the votes got separated. So now you can vote in favor of the merger and vote to ask for your money back. And since the warrants that you hold would be worthless if there is no merger, this creates an incentive where almost all the shareholders are going to want to vote in favor of a merger, whether they think it's a good merger or not. Otherwise, their warrants become worthless, and they can ask for their money back.
Okay, go ahead, Jay. We are halfway, and we look forward to hearing more later in the slides. And
Okay,
I will limit the questions only to clarifying. There are a lot of interesting questions for deeper discussions afterwards. So we will have plenty of time for that.
So the SPAC and operating company negotiate a merger, assuming it's approved. There's then an announcement. There's the announcement of a merger. Then there's a couple of months where the sponsor has to file with the SEC a document, typically an S4, giving details about the merger, and the shareholders have to approve it. And then once the merger is approved, the SPAC shares change their name into the operating company's name and start trading under that new name. And after that, the SPAC is no longer there. Instead, you've got the operating company, which is now publicly traded. And this is called the deSPAC period or post-merger period. So basically, the SPAC structure has a life cycle where in the SPAC period, you've got the IPO and then search, negotiation, approval, and then the deSPAC period where you've got an operating company has gone public. They've raised cash, the cash delivered by the SPAC. The sponsor will do well if the stock price goes up and their shares and warrants become very valuable. If the shareholders don't approve, things get liquidated. If the merger doesn't go well, investors get low returns. And frequently, and this is one of the ways that deals have evolved, of the sponsor shares, frequently they have vesting provisions where of the 5 million shares, there might be a lockup period, but then there might be vesting requirements where some of the shares only vest if the stock price is above a certain level, like $12 a share. So if the stock price stays below $10, the sponsor's economics deteriorate. Not only are the warrants not going to be valuable, but some of the shares that they owned, they'll lose because targets have not been hit. Okay. Now, there were some papers published dealing with the earlier SPACs, and there are two other concurrent papers, the Klausner, Olergry, and Ruan papers forthcoming in a law journal. And all of these document that on average, the deSPAC returns have been poor. So there are three main players: the operating companies, the sponsors, and public market and investors and pipes. And there are economic tensions, wealth transfers, agency issues, which is one of the reasons that this is interesting from a financial economics point of view. The costs of going public via a SPAC are high. For 47 SPAC mergers, Klausner, Ulrich, and Lewellen have calculated their costs, the underwriting fees, and the value of the sponsor shares and warrants as a percentage of the cash delivered, or as a percentage of the IPO proceeds, or as a percentage of the market cap at the time of the merger. And for the median SPAC, there are a lot of redemptions, and as a result, the costs of raising money via a SPAC are pretty high, because you've got all of these sponsor shares diluting the other shareholders. For a traditional IPO, we calculated those numbers and come in with numbers that are 1/2 to 1/3 as high. And a direct listing is even better, where the costs are really low. Very few investment banker fees and no dilution whatsoever. We're currently revising the paper to calculate the SPAC costs on an apples to apples comparison in terms of what's the market cap of securities issued relative to the amount of cash delivered to the operating company, the equivalent of underwriter fees plus money left on the table. And there's a lot of variation, but on average, SPACs look like they're very expensive. So this raises the question, why are these private companies choosing to go public via a SPAC merger when this is much more expensive than doing a traditional IPO? Well, this is where we discuss some of the economic roles of the sponsors, and some previous papers have also discussed this. The sponsors have been getting better in their quality. More and more of them, well, recently there have been some athletes and celebrities involved, but more common is people with financial industry experience and industry experience. You might have the retired chief executive of a company in the auto industry that's a sponsor looking for a deal in the electric vehicle space. You know, in general, more and more of the sponsors have industry expertise, and they might bring value to the transaction. And you know, even after the merger occurs, being on the board of directors, offering advice that creates value. Also, some of the sponsors are wealthy, either organizations like a venture capital firm or a wealthy individual, where if the deal gets in trouble, they might be able to step in with a PIPE transaction and put in $100 million of their own money. It's also the case that PIPE investors have been increasingly important as kind of a way of getting some third-party certification that this is the right value that we're putting on this operating company, that the pre-money value of the company is being validated by the fact that the sponsor is willing to put in $100 million of their own money. An extreme example is a deal that was announced 2 weeks ago of a SPAC merging with the Singapore-based company Grab, giving it a pre-money value of about $40 billion, where the SPAC had $500 million and raised PIPE investments of $4 billion. So they're going to be delivering about $4.5 billion in cash in by far the largest SPAC merger ever, measured both by the market cap of the operating company and the amount of cash being delivered. A more typical deal is $200 million and a pre-money market value of the company of 500 million to $1 billion. And with a pipe investment, you might have a couple hundred million more. So there are a lot of SPACs out there right now. There are over 400 SPACs looking for merger partners. And a lot of them are looking for unicorns, companies with a market value pre-money of roughly $1 billion or more. So what are some of the advantages of merging with a SPAC? Well, just like with an IPO, the cash being delivered. But one thing that's widely stated is that with an IPO, but from when you started until the deal gets completed, you don't know whether the deal is going to get completed. You don't know whether market conditions are going to be stronger or weaker. You don't know whether you're going to raise 50 million or $200 million. There's a lot of uncertainty there. It's a real stressful experience for most operating companies. With a SPAC, you're negotiating upfront how much cash is going to be delivered on minimum, what the pre-money value will be. There is a chance that the deal will get canceled, where the sponsor can't deliver the promised cash. So it's not as if it's riskless. And it's also the case there might be some renegotiation. What if they negotiate a pre-money value of $1 billion, but then the pipe investors say, well, we're only willing to put in money if that's given a haircut to $800 million. So it's not as if this is totally risk-free, but some of the uncertainty might be resolved at an earlier stage, and a lot of the operating companies like that. There's also a perception that it's a bit faster than a traditional IPO, although we're having difficulty finding evidence that that's in fact the case. There's been a lot of discussion about regulatory arbitrage. An IPO is a capital raising event. A SPAC IPO raises cash, but it's really boring. It just gets put into an escrow account. And so you don't get a lot of lawsuits there. The SPAC merger is a merger, and the view is that's regulated under merger law, where forward-looking statements can be made that have a safe harbor. Plaintiff attorneys have to prove that if things didn't work out, management knowingly made false and misleading statements. Now, just recently, the acting director of corporate finance of the SEC, John Coates, has raised the issue of let's not be so sure about this. The SEC does not define what an IPO is, and it's not clear that there is this regulatory arbitrage. The chief accountant of the SEC has also said, well, what about the accounting for sponsor warrants? Should these be counted as expenses on the income statement? After all, they're equivalent to employee stock options. You know, and once upon a time, employee stock options weren't expensed, but you know, maybe these warrants should be expensed. So a lot of things are in flux. But also with a merger, you can have contingent payments, earnouts, whereas with an IPO, you sell stock at a fixed price and that's it. It's much harder to have contingencies in there. Okay. Now, I mentioned before that sometimes sponsors give up some of their shares or warrants. If there are a lot of redemptions, in order to save the deal, sponsors very frequently take a haircut. They give up some of their shares, either forfeiting them or maybe to a pipe investor. They say, look, if you buy 5 million shares at $10 each, we will give you 1 million of our shares. So that's going to lower your average cost to just $8.33. You'll be putting in $50 million, but you'll get 6 million shares. And if public market investors redeem, it's very common for sponsors to take a haircut. On the other hand, if there's strong demand, if the stock price is well above $10, they don't have to take a haircut. What about the realized returns? Well, in the SPAC period through October of 2020, the average annualized return for IPO investors has been 9.3% with no downside risk. Not a single one lost money. And this is why hedge funds have thought these are such a great deal. On the other hand, the deSPAC returns have been kind of disappointing. They had been going up. If we had the numbers through the end of February, they would have looked fantastic. But the last 2 months, the last 7 weeks, things have come down a lot. For the deSPAC return for completed mergers in the last 10 years or so, in the 1 year after the merger, the average equally weighted return has been minus 15% when the stock market has gone up. So they've underperformed by like 23% relative to the market. But investors haven't done that badly if we don't equally weight, because if there are a lot of redemptions, that's when the returns are typically the worst. So a lot of the worst deals, investors have pulled out almost all their money. So if only $4 million was left, investors got a minus 90% return on 4 million, but on $200 million where they didn't redeem, they might have gotten a plus 10% return. So when we weight by the amount of cash invested, it still hasn't been great, but it's not as bad as on an equally weighted basis. And on average, the warrants have done quite well. Enough of them have gone up by a lot to compensate for some of the disappointing deals.
Okay, sorry for interrupting. 5 minutes.
Okay. The numbers vary by period. If we ended at the end of February, from the middle of last March until the middle of February this year was a phenomenal period, not only for the stock market, but especially for SPACs, and especially for the deSPAC period returns. Before and after, it hasn't been as great. And a couple of years from now, we'll have a lot more observations, given that there have been so many SPAC IPOs, over 500 SPAC IPOs in the last 12 months. As I mentioned before, there's some ability to predict the deSPAC returns. If investors are enthusiastic, it's more likely that they'll do well. If investors are redeeming and aren't enthusiastic, there's a real good chance it's going to do badly. Now, let's talk briefly about the evolution of the SPAC market. I've mentioned that this has been great for the IPO investors, 9.3% average annualized return due to the upside potential with no downside risk. Sponsors have responded to this. It's been really easy to sell an IPO of a SPAC in the last year, so they've changed the deal terms. The blue line here gives the dilution per unit. And what that refers to is, for the warrant component of a unit, how many shares does that buy? If each warrant gets 1 share, that would be 100% dilution. If each warrant gets half a share, that would be 50% dilution. And as you can see, that blue line has declined in the last 3 years. And indeed, this was through February. In the last 7 weeks, that number has come down to about 25%. That sponsors have been finding we can get plenty of IPO investors If we include a warrant to buy 1/4 of a share, why should we give them half a share? And this is good for the deSPAC period and the operating company as well. The warrants are potential future dilution. The less potential future dilution there is, the better it is for the other claim holders. So we're moving to a more sustainable equilibrium where the free lunch that had been available to the IPO investors is becoming less of a free lunch, which leaves a bigger share of the pie for the operating company and the deSPAC investors. The red line here is the average first day return. Until about 6 months ago, almost all SPACs went public at 10 and started trading in the market at 10 or maybe $10.05. In January and February, people figured out these are a real great deal. And the prices started jumping to 10.50, 10.60. If people really liked who the sponsor was, they might jump to $11 on the first day. In the past couple of weeks, though, they've come back to $10. We're also seeing some other changes in the details. Sometimes the deal structure is now 1/6 of a share for a warrant, and if you don't redeem, you get an extra 1/6 of a share. So that now there's a contingency. If you don't redeem, you get something extra. Sponsors are committing ex ante to put more of their own cash in. Pipes are becoming more and more important. I've been told that with the decline in the market the last few weeks, a lot of the pipe deals that had been agreed to a month or two ago are being renegotiated, where the pipe investors are looking at the fine print and saying, hey, we've got an opt-out. You've got to change the terms of the deal to make it more friendly to us, or we're pulling out and the deal's going to collapse. So things are very much in flux right now. Okay, so to conclude, a SPAC merger is a more expensive way of going public than a traditional IPO. It's got some advantages, although some of these advantages are in flux, that presumably are the reason why, even though there's a higher cost, a lot of operating companies have chosen to do a merger with a SPAC. In other words, this is an example of how us financial economists, by focusing on covariances and state contingencies, can explain why something exists, even though the average cost might appear to be higher than an alternative. But the covariances might be attractive in certain circumstances. To date, the IPO investors have gotten great risk-adjusted returns, but the market is changing. It's moving to a more sustainable equilibrium. And in particular, abnormally low deSPAC returns are also not a sustainable equilibrium, and deal terms will be renegotiated, so that's unlikely to continue. So let me stop there and turn it over.
Perfect. Thank you very much, Jay. Would you mind I'll share your screen? And today we're very happy to have Stefan Lewellen from Penn State to give the discussion on this paper. And Stefan, this floor is yours.
Great. Well, thanks to everybody for being here, and a special thanks to Mike and Zhang for asking me to discuss this paper. Can everybody hear me okay and see my slides?
Yes, all clear.
Okay. And I'm gonna write if in case I need to. All right. So I'm going to give basically a history lesson on SPACs. Jay talked a lot about the history. A lot of histories come up in the question. So I'm going to start by just walking through some of the history, because I think for those of you that aren't already in this literature, understanding the history is going to be very important for understanding the paper's contribution and framing. First of all, this is not a SPAC sponsor. This is Mark Twain. But Mark Twain actually is involved in SPACs in a weird way, which I'll explain in a minute. So Mark Twain's, has many famous quotes. One of the famous quotes is, "History doesn't repeat itself, but it often rhymes." And this is something that I'm going to return to. I'm going to repeat myself a little bit as the presentation goes on, and just try to explore, how the SPAC structure has evolved over time and what can explain those differences. Okay, Mark Twain, possible SPAC investor. I'll add a question mark there. Why do I say Mark Twain is involved with SPACs? Well, one of the SPACs that priced in January is a company called Affinity Gaming. Well, it was the operating company, I guess. And one of its properties is the Mark Twain Casino. So even Mark Twain can't avoid SPACs these days. Just goes to show how deeply embedded in our society they have become. And I think it's great that Jay has written this paper, because the literature has basically ignored this topic, with the exception of a few papers by people. I think everybody in the entire SPAC literature, which is like 4 people, is on this call. I'm looking at the chat and seeing all the same familiar names. So this is great. But with with your paper and your co-authors, Jay, we've basically like doubled the number of scholars interested in this, which is wonderful, and I think raised the profile a lot. Okay, so let me just go through a little bit of a history here. So as Jay mentioned, in the late 1980s, SPACs were sort of, well, in the 70s, they were even they were these blind pools. In the 1980s, the first sort of official SPAC was launched. They were really just called blank check companies. In fact, the SIC code, unless they've updated it, 6770 is still called blank check companies. These were very shady companies. And so in fact, partly because of how shady they were, the SEC passed a penny stock rule, because they traded OTC, and there was just a lot of shenanigans going on. So the first iteration of SPACs, they were seen as these sort of seedy, shady investments. The next wave came in the early 2000s. I would say the first sort of modern SPAC launched in 2003. And just like we're seeing now, there's this really steep ramp up in interest and attention in SPACs. So they went from being sleepy OTC instruments to, by the time really the market sort of died in 2008, you had reputable investment banks like Citi that were starting to sponsor and underwrite SPACs, and some very prominent institutional investors that are not just raiders were launching SPACs as well. 20 billion of issuance is not a small number. It was 58% of the IPO market. So this was a big deal back then. And just like today, there were many celebrities involved. So, baseball players, Hank Aaron, Tom Hicks, who's a very famous private equity investor, Lou Holtz, the football coach, Jack Kemp, the former politician, Ashton Kutcher, the actor, Nelson Peltz and Ronald Perlman, who were both well-known sort of corporate raiders, Dan Quayle, former vice president, Steve Wozniak and Gil Amelio, who were, Wozniak was one of the founders of Apple, Amelio was a former CEO. These are all people that launched SPACs during the 2.0 era. And so there was, still like the investment banks that were underwriting most of these SPACs were not, Goldman Sachs. I mean, they're still reputable companies, but, Morgan Joseph and these types of banks were really involved in the vast majority of SPAC issuance. It was only at the very end that the sort of bulge bracket type banks started getting involved. So SPACs were less seedy. They were sort of becoming more mainstream, but, there was still a bit of question mark. Are these really sort of reputable, highbrow investments, or is there something a little bit shady going on? And so that's the background for my very first paper as a first-year PhD student in grad school was, this was the original title, Heads I Win, Tails I'm Even, which sounds a lot like, a lot of what Jay's been talking about. This was the very first paper I wrote as an academic. So it's sort of a special, it has a special place in my heart. And I can tell you that this got a lot of attention from, and there were a couple of other papers that already existed at the time on SPACs, but this paper got a lot of attention by practitioners. So I can tell you I got a call from an investment banker who's still active, well, not name, who told me, in his thick New York accent, hey kid, I'm 3 years away from retirement, you say in the value destroying, it's got to stop now, retracted paper, this kind of attempts at getting me to, retract my paper just so that this guy could buy a bigger vacation home. Not surprisingly, given those types of conversations, FINRA and the SEC got interested. Hedge funds, I presented this at Weiss Capital Management. Weiss is one of the SPAC mafia that Jay listed. They've been heavily involved in SPACs for a long time. Long story short, the reason I'm saying all of this is because, a lot of the patterns that were in the literature, I guess back then, a lot of the patterns that emerged in SPACs then seem to also be present now. And so I think it's important to understand where the differences are today and what's causing those. So again, you see this rapid increase back then in issuance, both in volume and in number. You see the structure evolving over time. So for example, the average founder's investment went up a lot. The average underwriter fees at issuance went down a lot, but the deferred compensation went up a lot. And you see the trust value evolving to where by the end of the old SPAC 2.0 period, you get something very similar to what Jay was talking about, where now the trust value, you put in sort of the IPO is $10 and it doesn't get used to pay just for investment banking fees. That number stays stable. Okay. So one of the interesting facts that Jay didn't really talk about, but I think is interesting, back then, the SPAC would price at $10 a share, the common stock would price at $10, it would actually trade at a discount. So it would have a high yield. And so this was something that hedge funds took advantage of a lot, because basically the SPAC held treasury bills, but it was trading at a 4 or 5% yield, which means you could always just buy the SPAC, vote against the deal, and get a much higher return than you could earn on treasuries. And so you see that there was this discount. And I instead of calling it the SPAC period and the deSPAC period, I broke down the period a little bit more sort of granular buckets, and I said I broke it down into 4 periods basically. No target, meaning the SPAC has launched but hasn't named an acquisition target. Target found, which means the SPAC has announced an acquisition target but has not completed the deal. Acquisition completed means the deal's gone through. Acquisition withdrawn means basically it was voted down by shareholders. And what I found back then, which is again very, very similar in terms of common stock returns to what Jay's finding. Basically, once the deal's announced, shareholders seem to like it. Once it's completed, shareholders seem to not like it. And if you just construct a sort of long-short portfolio of these, you can earn, we're talking about like 46 observations here, but you're still earning large, significant abnormal returns. And you can, this is warrant. So that was the common stock, this is the warrant. So this is one place where Jay's results differ a lot from what the previous literature has found. So with warrants, you also basically found the same patterns, except of course, when an acquisition is withdrawn, the warrants become worthless. So you get this enormous negative return. But in contrast, Jay and his co-authors find that the return on warrants is now positive and large. And so that's something that I'll talk about more in just a second. Okay, just running through these 4-factor regressions, again, same pattern. So you see positive abnormal returns, positive alphas after the deal's been announced but not completed, negative alphas after the deal's been completed, very large 4% a month long short alphas with 46 observations. Okay. The other thing I looked at was institutional investors. So who's investing in these SPACs? And basically it's hedge funds. And what's interesting is that there's almost like habitats for investors. So you'd see more mutual funds, for example, would invest once the deal's been completed, once it was sort of an actual operating company. Whereas most hedge funds were investing in the stages where the deal either hadn't gotten to its sort of ultimate outcome, or they voted against the deal and took their money. So there was sort of a clientele effect. Okay, that's all background. So then what happened, there was a financial crisis, the market completely dried up. And this is a paper that's not cited in the current paper that should be, which is by Mark Mitchell and Todd Polvino, called Arbitrage Crashes and the Speed of Capital. And basically what happened in the financial crisis is all the hedge funds had redemptions and they had to sell their SPACs. And there were no natural buyers. And so the yields on these things ballooned like 15%, 10% yields. I was a big investor. I was one of the buyers when the hedge funds were sellers, because these things were, it's still cash sitting in, some account at JP Morgan, but you could get a 12% yield because investors just sort of fled. Okay. Then, so SPACs died for a few years and they started coming back. They started first coming back a little bit in the US, but mostly foreign. So there were SPAC booms in weird places like Malaysia. This all sets the stage for, this latest wave. And my sort of take on this latest wave, there have been some minor changes to the structure. The structure definitely does seem to have stabilized a bit. There have been some major changes to sort of how reputable SPACs are. Like now, Goldman Sachs, I talked to a former student of mine from LBS who is now an MD at Goldman, and he's like, I'm doing SPACs all day long. That wasn't the case in the last round. I highly recommend reading the appendix to Jay's paper, which goes through a history of SPACs and walks through some examples. And I think that really helps to clarify how the structure has evolved. I think the takeaway really now is like SPACs have gone mainstream and the volumes have just exploded. So of course, and this is Meb Faber's like a famous investor. He's emailing me like, hey, what's going on with SPACs? Have you updated your paper? So like this, like people are like mainstream investors are now really caring about SPACs. So of course the big question is why? And Jay's paper tries to help get at that. I think the paper offers a thoughtful combination of both just some facts, just putting some facts on the table, and thinking a little bit more about like what could be explaining cross-sectional variations in some of these findings. The main takeaways from this paper, in my view, are that there are a lot of similarities between the two. But the discount has turned into a premium. Jay doesn't really talk about this, but I think he should, because that's, to me at least, very interesting. There's this underwriter reputation effect, which I had tried to find, but with 46 observations couldn't. There's like Citi, and then there's everybody else. There's like one observation in the in one category. The two big sort of findings are that warrants seem to earn these really high returns, which wasn't true before, and that actually the returns aren't that bad if you dollar weight them, as opposed to doing what I did. And just looking at either equal weighting or, not sort of taking into consideration this idea that there are going to be higher redemptions for the worst performing deals, because back in the SPAC 2.0 days, if you voted to redeem your money, like Jay said, that was also a vote against the deal. So you didn't quite have, in some sense, this is an even more stark case. Another takeaway is, these sort of the role of pipes. Pipes really weren't that popular. They started coming in at the very end of the last wave. They weren't really that popular. Back in those days, we called the hedge funds holding up the SPAC mailing. This isn't exactly the same thing, but it has some of the same flavor of, well, let me just sort of get find some other investors. People are going to redeem their shares because this is a terrible deal. But let me go find some other money I can pull into this to get the deal through, so I don't lose all of my initial sort of investment. So, my first comment is this paper clearly makes a contribution to the literature. I think, most of the time when I discuss papers, the paper's saying, well, we find the causal effect of this on this, and my discussion is like, well, it's actually not maybe you're halfway there, but you're not really showing a causal effect. This paper actually does, it contributes exactly where it says it does. It says here are the contributions we make, and I don't have any quibbles with those. In fact, I think there are a couple of things that they should add to the list in terms of contributions. I think they're very good. The paper is very good about not claiming causality and not sort of saying, well, this happens because of that. I also like that the paper clearly explains, if you're going to just show a fact, you should explain why anybody should care about the fact. And I think the paper does a good job of explaining that. So I'm going to push Jay and his co-authors on 2 points. The first is really the sort of the ghost of Mark Twain, and this has come up a lot in the comments, is, okay, you're spending a lot of time in the paper and in the discussion talking about sort of explaining SPACs. But I think there is a literature that already sort of explains what SPACs do. And I think many of the features and outcomes are still the same. In fact, I'd say most of them are still the same. The basics of the structure are still the same. Most of the outcomes, stock returns, et cetera, seem to be the same. Jay's paper finds support for, so Laura Dimitrova has a paper that basically says, as you get closer to the date when the SPAC expires, this creates perverse incentives for managers to push a deal through. And that's what her paper finds. I had tried to find that. I didn't have enough data when I wrote my paper. She very nicely shows this, and it's a very nice paper. I encourage everybody to read it. And then Tim Jenkinson has a paper, which is contemporaneous with mine, that says that basically, if you look at the how SPACs react to how the market sort of reacts to deals, that should tell you whether they're going to be good deals or not. And Jay finds support for these as well. So they're basically the same results that the previous literature has found for most of the main features of SPACs. And so, the question I have is then, well, within this sort of small literature, what do we really learn from the paper's findings? There are clearly some differences. Why do those differences matter? So there's this stark change in returns between the shares and the warrants. And Jay's paper talks a little bit about why this could emerge. What I don't understand is why, none of those things shouldn't have been true in 2007. So, why did we see this massive change in what appears to me at least to be a massive change in outcomes between then and now? SPACs are expensive way for firms to IPO. I think that's exactly right. My guess is that, a simple revealed preference argument, as this came up in the comments, firms that can't IPO the normal way would do that. So I think this is somewhat analogous to pipes, and that, if you could raise the money in public markets in a normal way, you would. SPAC mailing has grown. There's now this pipe involvement. I don't know, is the involvement of pipes good or bad? Does this mean, does this mean the structure is more broken than it was before? Does it mean it's less broken than it was before? I don't really know. You talked about, how the structure is evolving, and it seems like it's more investor friendly. It probably is, but in equilibrium, how is this good or bad? I'm not sure. Same thing with discounts and premiums. Okay, so the discounts turned into a premium. Does this mean is anybody worse off? It seems like there must be something going on. It's sort of a zero-sum game here. So, there's still a lot of puzzling facts. This is a company that goes public with cash, right? Why do the shares jump at IPO? Why are people underpricing cash, right? That sort of doesn't make sense given a lot of the sort of standard theories that we have. What's going on? And I actually didn't send my paper to journals, mostly because I didn't have any testable hypotheses. I sort of also had these facts. And so I think that, to push this paper forward, it'd be really helpful to say something more about sort of whether these changes are good or bad, and sort of whether, if there's some story where these could emerge in equilibrium. And I'll get to, I think the equilibrium point is exactly the right one. And this is why I just sort of left my paper alone. The big question, the $115 billion question to me is, how in the world do you get SPACs to emerge in an equilibrium model of securities issuance? What frictions do you need to get something like SPACs? Because it seems like you need a lot. This does not seem like a simple issuance structure that should emerge. So I think something that can explain really anything about why SPACs are emerging as some sort of optimal structure would be a great contribution. How do we explain
1 minute?
How do we explain this weird underwriter compensation structure? Jay, you talked a lot about how things are changing over time. Why is this learning? Is this the market ecosystem is changing and this is a reaction to that? These are fascinating questions, and we don't have any answers to these questions. From a contracting perspective, why is it optimal to have this really stark incentive where, the founders lose everything if the deal doesn't go through, and then you have shareholders that can vote, but the voting sort of ends up getting hijacked by the management because of they don't want to lose their money? How is that optimal? How should we think about optimal contracting with noise traders? Because you need some sort of noise trader to explain why people would vote for a deal that's value destroying, right? There's a lot of questions here. Why do you get these waves of issuance? I have no idea. Why do shareholders vote in favor of these value destroying acquisitions? The SPAC investors I talk to and the investment bankers back in the day, at least, they made the forms intentionally complicated. So it wasn't just like a little simple form and you checked yes and then sent it back. You had to fill out a bunch of forms. And if there was any inconsistency, basically, they'd vote it as a yes. So it was almost like a deceptive tactic. You know, and that's why FINRA was interested, for example. Why does this happen? You know, that's interesting. How can there be this alpha creating event? So there's lots of papers now showing there's this huge negative return on when firms, once the deal is completed. And the explanation is, well, there's, you know, the sponsors promoting warrants, but that's predictable, right? How do you get this sort of alpha creating event that's mechanically driven by structure? It just, that's, you know, are markets really moving towards sort of an efficient equilibrium? It's just not clear. So I think this paper is great. It just raises as many questions as it answers. So my suggestions here, just first of all, just do more digging. You know, look at things, look at alphas, look at investors. Maybe like hedge funds and mutual funds, et cetera, are moving around now and they're holding different pieces of the puzzle. Maybe that can help explain why some of these patterns are changing. You know, can we do some cross-sectional analysis to see, for example, why we're getting premiums now versus discounts? Maybe there's something that explains that. Or maybe it's some one structural piece that's changed in the structure of the SPAC. Just generally, like, what can explain these differences between what we used to see and what we see now? I think just anything that can shed light on that would be really interesting. And then I think focus on the security design. I mean, this is, to me, again, like the $150 billion question. How did this emerge in equilibrium? You know, is there some historical parallel we can look at? Is there some small piece of the security design question that you can look at? I just, you know, is this, again, like, do you need these noise traders? Is this just something about sort of dumb investors and smart investors? How does this latest wave link to the closed-end fund discount? I looked at this in my first draft of my paper and didn't really find much. Mitchell and Polvino found that the SPAC discount and the closed-end fund discount were actually related. You know, can you do something with that? That might be interesting. And then, can SPACs be used to test models of issuance and reputation? So, you know, Kanano and Santi have this really neat model in RFS a long time ago, the same time as my paper, basically. I have a lot more gray hair now, I can tell you that. And, you know, they have this paper that basically says there's adverse selection in IPOs, and you get these sort of waves of IPOs, and that leads bad actors to sort of come in and pretend to be good types and sort of raise money. And it's a little deeper than that, but there's, you know, is there some, can we use SPACs? SPACs are a really clean, interesting structure. Can we use them to say something bigger about these models? You know, how much does underwriter reputation depend on outcomes? Of course, Jay, you know more than anybody in the world probably about this. To me, SPACs are super interesting because it seems like the return patterns are actually very similar, even though they've gone from being super seedy to then less seedy to now mainstream. So, you know, even though you're looking at these cross-sectional variation, you're saying, well, you know, when Goldman underwrites a SPAC, it does better than when, you know, Lewellen Securities underwrites it. But in the big picture, you know, it seems like the return patterns are still just as bad as they were before on average. And yet the average quality of the underwriter has definitely gone up. So, you know, can we say something deeper about those models? So I think there's a lot of digging that you can do. And I wish you the best of luck on that. I think it's a great paper. It pushes the literature forward in many ways. I think it raises as many questions as it answers. It adds to the SPAC literature by showing lots of stuff. Some of that got cut off. The main suggestion I have is really to just be more ambitious and you know, think a little bit more deeply about how the theory of this should work, and you know, and see where that leads you, because really, again, anything that we can link back to sort of mainstream theories of issuance beyond, you know, what the previous literature has shown, which is really not much, I think anything would be really beneficial. Thank you.
Thank you, Stefan. That was a really useful and thoughtful discussion. Jay, I want to give you a chance to respond, certainly, but Song has asked me, has basically tasked me with trying to take this voluminous chat, all these questions that have come up, and try to, you know, direct a few of them at you to sort of open up the floor for broader conversation. So Let me just kind of maybe throw one question / comment out to you as you're thinking about responding to Stefan, and then I'll work through some more questions in the chat. And it would be this, and I guess it's really kind of building on something that Stefan was saying. Zhang in the chat window a while back was asking this question, what do you think the key market friction is that the SPACs are responding to? And I guess I would return to that question to start, but I would broaden it slightly and say, we're either responding to a market friction or a pain point in the market, or we're reacting to an opportunity in the market. And so when I think about these, Stefan's earlier paper makes some references to private equity. You can see how developments in the private equity sector might naturally put pressure on this side of the market for SPACs to evolve, because you've got a lot of dry powder in private equity. You've got a lot of portfolio companies that sort of need to be exited. And so maybe SPACs are a channel by which that happens. At the same token, when I see the name of an actor associated with a financial transaction, I immediately think the exploitation of retail investors. And so maybe this is, maybe part of this kind of coincides with the rise of Robinhood and everything else. I'll also just throw out one thing. I think there's a fascinating similarity here between SPACs and what happens at the very far extreme other end of the private equity market, which is, we're talking about small and mid-market buyout transactions, which are that there are these things called search funds, which are basically 2 MBA students raise search capital from a group of private investors, go hunt around, find a company with $10 million of EBITDA and buy it and run it and then sell it 5 or 6 years later. And would welcome some comments on any of that.
Okay, I'll just keep my comments short here so that we can entertain other questions. I want to thank Stefan for outstanding comments, and we'll definitely follow up on a lot of them. One of the things we'll definitely add is more discussion of the literature that was based upon that SPAC 2.0 period. He mentioned the 2012 JFE article by Mitchell and Palvino. I've actually read that article, which but I had forgotten that it discussed SPACs. It was mainly, as I recall, focusing on convertible bonds. And just as Stefan mentioned that back in the financial crisis, he took advantage of the market's mispricing of SPACs. I took advantage of the market's mispricing of closed-end funds and convertible bonds. And so that's what I was paying attention to when I read that article. But in any case, thanks very much for the comments. In terms of the friction, kind of the main friction that practitioners talk about without using the terminology friction is the ability of the merger explanations to include forecasts of revenue and profits that in general are not there with IPOs. That, they frequently say that an advantage of merging with a SPAC is a company is allowed to tell a holistic story about its great growth potential. How this company with no revenue in the electric vehicle space will be selling $10 billion worth of EVs 3 years from now. Maybe this is retail investor exploitation. I'm short in Tesla. There might be something to this. Everybody agrees, and I certainly agree that the huge volume of SPAC IPOs in the last 12 months is totally unsustainable. Just how much mean reversion there is, whether it's going to revert to 20 deals a year or 50 deals a year remains to be seen. Okay, why don't we open it up for some questions?
let me see here. I'm going to try to moderate this and try to find a question here that's kind of building on what you were saying. Avri Ravid has a question about the sort of the quality of the underlying firm, and maybe Ravi, Avri, if you'd like to unmute and ask your question.
Hi, Jay and everybody. Thank you very much for this really fascinating talk. I've been thinking about SPACs for a little bit, and this kind of helped a great deal. So this builds on everything else. So there's the issue of the equilibrium and the issue of the friction that people were, Stefan was talking about. So one thing that's in the press, I mean, I'm just looking at the front page of the Wall Street Journal, it says insiders gain in SPAC deal while investors take losses. So the talk has been that low quality firms would go public via SPACs, whereas high quality firms would go via traditional route. And that aligns with a high cost. On the other hand, there's the question of the equilibrium. If everybody sees it, how does it actually work? And my thinking was it might be more uncertainty. So if you can't really say anything, that you might be able to go public via SPAC. And in that case, you would empirically see that some firms are very successful. You have the negative returns, but some firms are very successful and some are not. So I'm wondering about this quality issue. And the other question was about the voting incentives. So if I want to get out, what are my incentives? Since it doesn't matter, I could take my money and still vote for the deal. What are the exact incentives for people to vote against the deal? Are they and not go out? Are they waiting for a better deal? How does the equilibrium work here?
Yeah. There's typically a deadline, 2 years, which effectively means a deal has to be proposed within 18 months. If a deal is proposed 12 months beforehand, 12 months after the IPO, a shareholder might vote no on the grounds that, no, this deal isn't good enough. There's still time to come up with a better deal. But as that deadline is approaching, because their warrants are going to become worthless, there's no incentive to vote against a deal. But why is there a deadline then? Well, just like with for venture capital and buyouts, typically when they raise a fund, they've got to, there's a period, typically 5 years, with which they've got to invest the capital that's been committed, because otherwise, there's an opportunity cost for the LPs of having tied up capital. And a way of dealing with that agency problem is to put in a deadline. Well, that's, for the SPAC IPO investor, your cash has been put in an escrow account. There's an opportunity cost. You can't get it out until a merger has been proposed. And so a deadline solves one agency problem, but creates another agency problem. Life is full of trade-offs. In terms of deal quality, your first question, in the next version of our paper, we're going to add more information about the types of companies that have been involved in SPAC mergers as compared with IPOs. It turns out that in terms of the frequency with which they're profitable, the age since the company was founded, the sales are not that much different when you look at the two groups of companies. For biopharmaceutical startups, they have been overwhelmingly traditional IPOs, very few SPAC mergers. The EV space has recently been SPAC mergers, but that's not a huge fraction of the SPAC universe. And it's still the case, especially recently, that PIPE investors are being brought in, where partly they're performing a certification function. If they're putting in $100 million of their own cash, they've got a big incentive to do due diligence and certify that, yeah, we think the pre-money value of this company is worth $400 million. Investors pay attention to who is the sponsor, Who is the underwriter? Who are the pipe investors? These third-party certifications are obviously very important. That said, you know, I'm not going to claim the market gets it exactly right, but you know, things continue to evolve to a more sustainable equilibrium.
It's interesting to think about that certification role and how it connects back to the this older literature and the M&A literature around the free rider problem. And because you can imagine that basically it serves to solve that very same problem here. You've got small scale dispersed investors buying into these things. We've maybe got time for one more question. We're running a little over our intended time, but this is a well-attended and active talk. And so I want to maybe just give one more second to another question here. Let me see. I guess actually maybe let's draw it to a close here with this. Jay, we want to thank you very much for this very interesting presentation. Stefan, thank you for your comments. I thought this was a really interesting discussion, and that's evidenced by the incredible amount of participation we had here on the call. So thanks to everyone for attending, and please check out the WEFI webpage where you'll see upcoming talks and lectures posted. Thank you all and have a great day.
Okay, and one last comment. Remember to give credit to my co-authors, Minmo Gahng and Donghang Zhang as well.
Absolutely, absolutely.
Thank you.
Thank
Thank
you.
you
Thank you
all.
everyone for attending.